So 15 years ago, if you said self-storage is an institutional asset class, people would have laughed at you. Mobile home parks, and yet all of those have been institutionalized. And now data centers, life science, single-family rentals, these are all existing asset classes or existing sectors that have become more and more institutionalized.
This is Durable Value. Get investing and business insights from industry experts and successful entrepreneurs every week. Like and subscribe now.
So now Ryan is going to come up and speak with us a little bit, and he's going to talk about some of the changing dynamics we're seeing in the market as a firm and kind of highlight some of the good, the bad, the ugly. So I'll have Ryan come back up.
2022. We used to lament 2020 and want to forget 2020. And I think many of us are starting to wonder if 2022 is one of those as well. There's a lot of changing market dynamics. And I thought what I would start with is long-term secular trends that affect our business, and then we'll get down to kind of short-term cyclical trends that also affect our business. Everything I'm going to be talking about is in relation to our investing in our business. I think all of us have heard lots of economists, so I'm not here to prognosticate. I'm here to tell you about how it affects our business. So first kind of secular trend is migration of people, and we've seen this. There was a Wall Street Journal article 2 days ago, I think, that said that the average distance that people move today is higher than it has ever been since they've been recording the data, average of over 50 miles. Why is this happening? People are searching for affordability, they're searching for quality of life, but why is this happening now? Technological advance has allowed people to work remotely, it's allowed people to work as independent contractors. We've also seen businesses that traditionally were in primary markets start to have headquarter or satellite offices in other markets. And then certainly the pandemic came along and it just accelerated that trend. People never really thought about the amount of time that they were spending in their car or in public transit commuting. And all of a sudden that became an important thing, and they started to reprioritize aspects of their life. That's a trend that we don't see letting up. But the second secular trend that we want to talk about is capital flows. So this same diagram is representative of capital flows as well. 30 years ago, institutional allocation to real estate and private markets in general. So private markets is venture capital, private equity, real estate. Institutional allocation to private markets was just a tiny wedge on their whole portfolio. It was the traditional 60-40 equities, bonds. That over the last decades, that wedge has grown larger and larger and larger, and that trend is continuing going forward. So we've got a case where institutional capital is allocating more and more into the private markets, and particularly into the real estate space. Then add to that private individuals, non-institutional investors, many of us here in the room, that again, traditionally it was a 60-40 split between stocks and bonds, and more people are looking for that access to venture capital, to private equity, to private real estate. So what does that mean for us? When you've got more and more capital allocating somewhere, where does that capital go? Well, what's happened is that more aspects, more sectors of real estate have become institutionalized. So 15 years ago, if you said self-storage is an institutional asset class, people would have laughed at you. Mobile home parks, and yet all of those have been institutionalized. And now data centers, life science, single-family rentals, these are all existing asset classes or existing sectors that have become more and more institutionalized. We see secondary and tertiary markets as kind of this vast frontier of really trillions of dollars. Just in the Western United States, there's trillions of dollars of private real estate in secondary and tertiary markets. And who owns that right now? It's primarily individuals, families. It's non-institutional. And that's why we focus on bringing an institutional approach into these markets, because we see over the next 10, 20 years, it's an inevitability that all of these markets, Boise, Albuquerque, Bakersfield, these will all become more institutional. And we're not alone. Groups like Blackstone, Goldman Sachs actually looked at doing an investment into Fund 3. They will likely be a Fund 4 investor. Dow Chemical, Oak Street, Hilton Foundation. These are all groups and many others who have really resonated with our strategy because they see not only that market opportunity, but they also see our approach to how we're doing it as something that's meaningful. So those are kind of, I'd say, the two long-term secular shifts, which is capital and people. And then let's get into the short-term cyclical trends, because these are the ones that I think everybody's thinking about. Nobody's thinking about the two that I mentioned earlier. We're thinking about things like inflation, recession, interest rates, all those sort of things. So I think this graph really translates into all of this, or many of the cyclical trends that we're dealing with right now. This is the Fed funds rate. So as the Fed interest rate goes up, what of course happens, and probably the biggest impact to real estate right now is borrowing costs. Interest rates are going up. For our existing portfolio, fortunately, we're virtually completely hedged, and that goes back to our, like I mentioned earlier, bad debt makes good investors make bad decisions. So we've always preferred fixed rate debt. We've always preferred balance sheet lenders. And so as we get into an environment like this, our existing portfolio is unaffected by interest rate changes. Buying new things, on the other hand, is absolutely affected because debt costs have gone up. And so if debt costs go up, I, as an investor, if debt costs went up, the price that I could pay for that just went down. So we're seeing this across the board. You've probably read about it in residential as well. But as interest rates go up, values go down. So this is a great time for being a buyer in this market. We're excited to be a buyer. Being a seller in this market is a little bit more challenging because values have gone down. For us, because we have a value add strategy, if you look at our existing portfolio, our values have gone up because of the work that we do, not because of the market, because the market certainly is trending down right now. But because of the work that we do, the value is going up. So we are with specific assets, we are still a seller because we've made enough money on that asset that it makes sense to sell. But I would generally describe our position in this market as a cautious buyer. We churn through a lot more assets. We do a lot more underwriting. We've also trended up our threshold interest rate, internal rate of return, IRR. So essentially we need a little bit more return to make us comfortable transacting in this market. So it's certainly not a time that we are, out of market, but it is, frankly, it's a little bit more of the opposite. We view this particular time as a time more ripe than perhaps 6 or 9 months from now. Because the other two cyclical trends that I want to talk about are denominator effect and price discovery. So denominator effect means institutional capital has an allocation into real estate, into stocks, into bonds. Stock market drops as it has, and all of a sudden they are over allocated in real estate, not because of anything that real estate has done. So institutional capital generally is more on the sidelines right now. So there's less buyers in the market. The other thing that's occurring right now is price discovery, which means when the sellers and buyers can't generally agree on what the price is. Sellers are wanting to sell at yesterday's price. Buyers are wanting to buy at today's price. And again, that is a time where there's actually a lot of opportunity if you can find the sellers that have accepted this new reality. 6 months from now, we anticipate that to be a lot more, borne out. But this time of price discovery is really a unique time. I want to speak a little bit to recession. So I guess what I would say is we are not market timers. and we are not market forecasters. What I mean by that is we don't make our investment decisions based on trying to time the market. We don't make our investment decisions based on future forecasts. We make our investment decisions based on what's actually happening right now and what that current asset needs. So I would frame that a little bit as we go into talks of recession. We can't be predicting, is this going to be a shallow recession? Is this going to be a deep recession? What we can do is we can scenario play. If it is a deep recession, what does that do to our portfolio? And I would say we've been doing that probably for the last 5 years because of that recessionary mindset. During this trending up market, we have constantly been kind of looking over our shoulders, wondering when the shoe is going to drop. And I think now we are actually seeing the shoe drop. So what does that mean for our portfolio? Well, if we're always mindful of a downturn, as we've mentioned before, we've focused on conservative debt. We focus on adding value quickly, because when we add value quickly, that builds margin of safety. So that's why we can be even a seller in this environment, because we've added so much value to properties. And we've generally been low leverage. Our portfolio-wide leverage is 54%, I believe, right now. And being vertically integrated allows us to quickly react to the environment and allows us to have instant feedback. By vertically integrated, I mean that we have property management staff on the properties that we own. We have people in the markets where we invest. That allows us to very quickly be able to have that feedback loop as the market changes. So that's where I'm not predicting the future. We're not attempting to predict the future. Instead, what we do is we prepare for it, and we've been preparing our portfolio for it for many years now. So now I want to switch to some good news on short-term cyclical trends. And one of the things that is good for us is inflation. And that's not good for any of us in the room in our pocketbooks. But from a real estate standpoint, inflation is a good thing. We're certainly not banking on it. We're actually hopeful that the Fed's efforts will bring inflation back, to a reasonable level. That being said, real estate has the highest correlation to inflation of any asset class. So what that means is as inflation goes up, real estate values tend to go up in lockstep with inflation. And that's because, of course, rents generally rise with inflation. That's not always the case. But I wrote an article in Institutional Real Estate Americas recently about how our strategy is particularly inflation correlated. If you buy a Amazon warehouse with a 10-year lease, that rent only goes up by whatever the contracted increases are within the lease. It might be 2%, 3%, something like that. So that does not track with inflation. We buy assets that are highly multi-tenant, that have constant leases rolling over. And as you have those, so think the multifamily, small bay industrial, these leases are constantly rolling over, and so we're able to bring rents to market as rents increase. So it's very inflation correlated. So inflation bad for us individually, good for us in our investing. The other cyclical trend that is good for us is housing demand. Housing supply never caught up with housing demand after the Great Recession. I'm sure all of us have read articles about the kind of chronic imbalance between supply and demand for housing. Well, as interest rates go up, all of a sudden, development costs go up, debt costs on new development go up, inflation has made construction costs go up. So new development of single-family homes, of multifamily, are getting harder and harder to do. For us as an investor in existing multifamily, this is generally a good thing because it means that rents will continue to rise in a more meaningful way because there isn't new supply coming onto the market. And then I want to speak to the labor market. So we have experienced the tightest labor market on record. Employers everywhere are having a hard time finding good qualified employees. I think all of us have had experiences in restaurants where we wonder if the server has ever served people before because they're desperately trying to find people to be able to employ. And meanwhile, we just, introduced you to some of the stellar people that we have in our company. So why is it that during this time of the hardest time to hire people, we're able to bring on exceptional people? And fundamentally, that comes down to two things. It comes down to our culture, and it comes down to our vision or our purpose. We already spoke to those a little bit. Positive, caring, and humble, owns the mission, does the right thing, excellence in execution, and wants to win. As we said, we live and die by these. We hire and fire by these. And it creates an environment during the tightest labor market ever. It creates an environment where people want to be because it's a dynamic environment that rewards excellence. It's a caring environment. And ultimately, groups, as I mentioned, like Goldman Sachs and Blackstone are looking at investing with us. Our goal ultimately is that we are competing with them. We see this market, the secondary, tertiary market strategy, we see this as a highly scalable, we see ourselves as being on the beginning of a trend. And so the folks in this room and the other members of our team, they see that. They see not only where we have been and where we are, but they see where we are going. And that's been really critical for us. Our purpose, when we really get down to why we're doing this, is we create environments that transform people's lives. Well, what do we mean by that? There's really three areas that this transcends. One is the work environment. Our goal is to create environments that transforms people's lives for our coworkers, for our vendors. It translates into properties. As we move into, as we do our value add strategy, that means that we're going into markets, frankly, that are underinvested. A lot of the markets that we're going into, institutional capital doesn't regularly go yet. And so we're coming in and we're bringing that expertise. We're taking the existing real estate stock in that market and we're elevating it. We pretty regularly have residential tenants say, thank you for buying the property. And meanwhile, our job is to bring the property to current, amenities and to raise the rent. Well, why would a residential tenant say, thank you for buying the property and raising my rent? The reason is because we're typically buying from owners who have mismanaged the property, who have been bad landlords, who have not invested in the property the way that it should have been. And so a lot of times, our tenants, they have an owner that they can call, that they can actually have a conversation with, that we can develop a relationship with. They have an owner who, like Carson Air, which we'll see later today, who actually, keeps the pool in good condition, who actually updates the landscaping and makes the property something that you're proud of as a tenant. This also translates into sustainability. We do energy audits on our properties. We do sustainability audits, and we don't approach that. We always approach that from an authentic standpoint. So we're always focused on what improvements are going to yield the best return on investment and yield the best outcome for that property. So when you're working in primary markets, a lot of the kind of low-hanging fruit of energy efficiency, water efficiency, that sort of thing, they've already been done. In the markets where we work, many of the properties that we're touching, maybe that's the first time that property has been touched in decades. So it's very easy to find high return investments in the property that also make the property a more sustainable contributing property as well. So I just want to touch on the last point of our mission of improving lives. We create environments that transform people's lives, and that is community. And community, again, is approached from a very authentic standpoint. We have team members who created a community service committee where they figure out which initiatives and endeavors we want to pursue. So we've supported Orville Wright Elementary School in Modesto. We've supported veterans programs, homeless programs. But besides everybody's DNA in our firm that makes them want to contribute to the community, we also really program it into what we do. So we have paid volunteer time so that people can actually be paid during work hours to go do volunteer work. We also have this thing called Making Memories, which is Leanne's invention, so I'm sorry she couldn't be here today. But Making Memories is it is us programming into the budget at a multifamily property a line item that is for the community manager and the other staff to be able to identify when there are tenants that have some sort of a need. So like an example might be a family's expecting a baby and we provide a welcome package or a care package with, some clothing and other things for the baby. So again, it's not just, hey, do it on your own time, but we actually program it into the DNA of the work that we do. And then I wanted to speak just briefly about Graceada Scholars, which is something that Joe and I are really excited about. This is actually modeling after an entrepreneur in Florida who did this in the Orlando area. And what we've decided to do is pay for the full college cost of graduates who are graduating from high school, going on to college from the airport neighborhood. So anyone from the Modesto area knows the airport neighborhood is probably the most socioeconomically disadvantaged neighborhood. And our goal is ultimately to be able to help fund the cost of every college-bound student out of that neighborhood. We started with 1 2 years ago. We added 3 more last year, and our hope is to continue to add more. So we're really excited about the work that we're doing and the work that we have ahead of us. I just want to finish by saying that, these are times, these are very trying times, or they're very challenging times. We all wonder exactly how the cards are going to fall, so politically, economically, geopolitically, all sorts of things. And these are the times when experts thrive and when less disciplined firms struggle. So it sounds strange to say, but we've been looking forward to these times because for the last 5 years, we've really just had this run up in real estate. And it's easy for anyone to look like a genius during that time, but the time that we have ahead of us is really a time when it allows experts to thrive.
Thank you for listening to Durable Value, an investors podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GraceadaPartners.com, where you'll find more information, investors tools, case studies, and more. Thanks again for listening, and we'll see you next time.